Let's create a budget. Let's get out of debt. Let's build wealth. Guys, welcome back to the channel. So as we continue on with dissecting velocity banking, today we're going to look at interest rate. And interest rate it can affect and change the effectiveness of velocity banking. And really, interest rate is a twofold process. So in velocity banking, you have debt, and then you have the tool that you're going to be using to get rid of that debt. So your debt is usually an amortized type loan, and your line of credit or wherever that revolving line of credit that you're using is usually simple interest. So when looking at velocity banking, its effectiveness and whether it'll be other methods, the interest rate will play a role in this. So usually you have debt. Let's say that debt is at 10% interest rate, and then you have your revolving line of credit that you're going to be used to eliminate that debt, and it's also at 10%. So this will still work. Velocity banking is still going to work because that revolving line of credit, no matter what that interest rate, if that interest rate is equal to the amortized, it's always going to work because it's not really 10%. As soon as you park cash in that line of credit, it drops that interest rate. And even if the line of credit interest rate is higher than that of the debt, it'll still be effective, and you could still use velocity banking to eliminate that debt. You know, how high can that line of credit be? That would just kind of determine on the loan, the amount of the loan, the length of the loan, and things like that. And if the reverse happens, this would be even better. You have a high interest rate on debt, you have a low interest rate on a revolving line of credit, and, amortized versus simple interest. It's going to greatly, this could change someone's outlook on how effective velocity banking is, and that's why there's so many arguments over it, because there's so many factors that go into it. So let's just do one or two examples on this. But we're going to start off with, for this example, we're going to use $10,000, and we're going to start off with 18%. And before we start that, so the column on the left, the debt side, the percent will only matter if it's multiple debt. If it's a single debt and you're knocking out the entire debt in one go, the interest rate on the left doesn't even apply. It doesn't matter, because we'll be paying off. Well, it may affect it a little bit on the total payoff of that debt, but other than that, it's not going to really affect how velocity banking, the credit, now the percent on the credit line, it'll affect it to some degree. So looking at $10,000 at an 18% interest rate and sending $1,000 a month to eliminate this, $1,000 every month, this would take a total of, you jump down to month 11, it'll be paid off in month 11, and it'll be $749.08 for that final payment. We'll pay a total interest of $749.08. So it will be paid off in 11 months, $749.08 in interest. So we know at 18% revolving line of credit, it will take us 11 months, $749.08 total in interest. So let's look at if the line of credit was at 5%. So running this at 5%, assuming we have two people, both owing $10,000 on a amortized loan, and both of them having a revolving line of credit, and they both just chunked that amortized loan onto their revolving line of credit. One person's line of credit was 18%, the other person's line of credit was 5%. So let's look at the difference. paying the $1,000 every month, we jump down to month 11. So at 5%, it'll also be paid off in month 11. That final payment in month 11 is going to be $193.11. So let's look at the interest. So at 5%, the total interest is going to be $193.11. So both lines of credit paid off in the same month. The difference in interest is quite a bit. The 5% it's a total of $555.97 difference. So, you know, exact same situation. You have two people, they both owe $10,000 on a amortized loan, and they both had lines of credit. The only difference was their lines of credit had different interest rates on it. So that can affect the outcome. You know, this could be the difference between maybe debt snowball or debt avalanche would have been better for the person with 18%, but the person with 5% would have beat it. Or this could make someone's outlook on velocity banking be more positive or more negative depending on the results that they got. So by dissecting velocity banking and understanding this, you can understand the different points of views on velocity banking. So guys, I really hope this video kind of helped to understand how interest rate, when it comes to velocity banking, how it can affect the effectiveness of it, and how it can, you can see how it can change the views on this velocity banking between two different people. So if you found value in this video, I would appreciate a thumbs up. Don't forget to subscribe and hit that notification bell, and I'll see you in the next video.